After a decade of low inflation, the European Central Bank is facing the highest rate of price increase since the creation of the euro currency. The European Central Banks enter a new era, as policymakers announced they plan to raise interest rates in July for the first time in more than a decade to control inflation. To prepare for that move, the bank confirmed that it will stop growing its bond buying programs this month. After 8 years is the end of the bank's negative interest rates policy and huge assets purchase program, which has collected trillions of euros of government debt. Hi, my name is Gio. Hope you're doing well in these challenging times. In today's episode, let's see what the European Central Bank is planning to do with the interest rates and how it could affect us. Let's get right into it. First of all, what determines interest rates? Interest rates reflect the cost of borrowing money, and they are a critical part of our economic system. At their most basic level, they enable the lending and saving of money which we need for our economy to function. In many developed countries, there is a benchmark interest rate, sometimes called a base rate or policy rate, which is the rate at which the country's central banks lend to other banks. The central bank raised and lowered these rates in response to economic conditions. If the economy is growing quickly or inflation is too high, the central bank may increase interest rates. In turn, this often results in retail banks to raise the rates at which they lend, pushing up the cost of borrowing. Bonds may also raise their deposit rates, which makes savings more attractive. On the other hand, if the economy is slowing, the central bank may reduce the base rate. In turn, retail banks may lower their rates, making it more attractive to borrow and spend money, but less attractive to save it. The European Central Bank said it plans to carry out its first interest rate increase in 11 years next month in July, followed by another hike in September as it catch up with other central banks worldwide for supporting the economy during the pandemic to stabilize soaring inflation. The surprise announcement came after the bank's 25 members monetary policy councils met in Amsterdam, saying inflation had become a major challenge in the 19 countries that use the euro currency. It will end its economic stimulus program and raise rates by a quarter point in July. The move underlines concerns about surging consumer prices, which rose by an annual rate of 8.1% in May, the highest since statistics started in the 1997. The bank's target is 2%. Russia's war in Ukraine has sent shockwaves through the European economy, particularly through rising energy prices. Sky-high energy prices were blamed for most of the surge in inflation. It raised its outlook for inflation, saying that price increase would average 6.8% this year, higher than the 5.1% in its March prediction. It also increased the expectation for 2024 to 2.1% from 1.9%. That is significant because it indicates the bank sees inflation as above target for several years, a strong argument for more rate increases. The European Central Bank also cut its growth forecast for the Eurozone from 3.7% to 2.8% for 2022 and from 2.8% to 2.1% for 2023. The euro's exchange rate to the dollar jumped by almost a half cent to $1.076 after the decision. The sudden jump indicates the bank had gone farther than expected in announcing rate rises. An European Central Bank move to attack inflation has raised concern about the impact of highest interest rates on heavily indebted governments, particularly in Italy after its debt to GDP ratio increased to 160% during the pandemic. The bank announced no new support measure that could help such countries, saying only that it will respond flexibly if some parts of the Eurozone were facing excessive borrowing costs. The increase will start from record low of 0 to European Central Bank's lending rate to banks and negative 0.5% on overnight deposits from banks. In the US, the Federal Reserve started raising rates in March and implemented a 50 basis points hike in May, its largest in 22 years, with the Federal Open Market Committee meeting pointed to further aggressive increases ahead. If you want to know more about the Federal Reserve and interest rates, you can check out this video. The The Swiss National Bank and the National Bank of Hungary both cut market of guard with a big upward step just after the Federal Reserve lifted rates. The Swiss National Bank raised its policy rate to negative 0.25% from the negative 0.75%, a step so large not a single economist had predicted it. The first Swiss National Bank raise since 2007, it's unlikely to be the last. However, the bank could be out of negative territory this year. The new inflation forecast shows that further increases in the policy rate may be necessary in the future. The Swiss franc jumped almost 1.8% against the euro on the decision and was headed for the biggest daily rise since January 2015, when the Swiss National Bank detached the franc from its euro peg. The Bank of England has increased rates at 4 consecutive meetings to take the base interest rate to a 13-year high, short-term versus long-term rates. While central banks are responsible for setting a country's short-term rates, they do not control long-term interest rates. Instead, it is the market force of supply and demand that determine long-term bond pricing. In turn, this provides direction for long-term interest rates. For example, if market participants believe a central bank has set interest rates too low, they may worry about potentially increase in inflation. To compensate for this risk, issuers of long-dated bonds will tend to offer higher interest rates. This may cause the yield curve, which reflects the relationship between long and short-term bonds. Why interest rates affect bonds? Bond prices have an inverse relationship with interest rates. This means that when interest rates go up, bonds will go down, and when interest rates go down, bonds will go up. The reason? The price of a bond reflects the value of the income it delivers through its coupon, which is interest payment. If prevailing interest rates, which is rate of government bond, are falling, older bonds that offer higher interest rates become more valuable. The investors who hold these bonds can charge a premium to sell them in the secondary market. Alternatively, if prevailing interest rates are increasing, older bonds become less valuable because their coupon payments are now lower than those of new bonds being offered in the market. The price of these older bonds drop, and they are described as trading at a discount. This risk caused by changing interest rates is called interest rate risk. In the short run, rising interest rates may negatively affect the value of a bond portfolio. However, over the long run, rising interest rates can actually increase a bond portfolio's overall return. This is because money from maturing bonds can be reinvested into new bonds with a higher yield. The actual change in monetary policy of leading central banks raised the following questions. What will happen when the European central banks actually raise the key interest rates in 2022? What ramification will this have for consumers and businesses, as well as for national economies and government? And what will be the resulting economic and social challenges? First of all, it is important to consider the current monetary environment in which a key interest rate hikes will take place. As a reaction to the financial crisis in 2008, the European Central Bank lowered its key interest rates to support the economic recovery and prevent deflation. By 2015, the target interest rates had been lowered to zero, without having achieved the desired effect. The European Central Bank consequently expanded its monetary policy instruments to include what is known as quantitative easing, a program for the purchase of government bonds and other financial assets based on similar programs created by the Federal Reserve in the United States or the Bank of England. For the last 6 years, the key interest rates in Euro area have been at 0%. During this period, the European Central Bank's balance sheet has increased substantially. Between 2015 and 2021, it tripled from 2.7 billion euros to 8.6 billion euros. What will happen if European central banks reduce its bond purchase and raise the key interest rates in this monetary environment? A look at the effect of the Federal Reserve announcement of tightening its monetary policy holds a really good lesson for the euro area. The announcement of Federal Reserve ending its bond purchasing program in March 2022 not only drove up the return on US government bonds, but also result in corresponding securities in the euro area's biggest economy. This demonstrates that investors not only react to actual market development such as interest rates increases, but rather anticipate these developments and factor them in accordingly. Rising yields on government bonds increase the refinancing cost for commercial banks, who then pass this cost onto their customers in form of higher interest rates on loans. This brings us back to our initial question. What consequences will the European Central Bank's interest rates increase have for the individual consumers, for businesses, and for the national economy as a whole? A general increase of the interest rate will result in higher yield on saving deposit for consumers and will also lead to higher price stability as a result of declining inflation rate. At the same time, loans will become more expensive, slowing down private investment. In addition, higher interest rates could have a negative impact on consumption, hurting economic growth. For businesses, an interest rate increase and the resulting decline in inflation will have the benefit of reducing the risk of a pending price or wage spiral. Businesses profit from price stability as this facilitates planning regarding future costs and profit. Yet, higher borrowing costs will also make it more difficult for businesses to follow their planned investment. A decline in inflation will primarily protect those parts of the population that are particularly vulnerable to an increase in consumer price, as they use most of their finances for everyday necessities. On the other hand, rising interest rates make government borrowing more expensive to obtain government loans, which could reduce public spending and leading to a weaker growth. Thank you so much for watching. As always, if you find this content helpful, smash that like and subscribe button to help this channel grow, turn on the notification bell, and check out all the links in the description down below for some free stuff. See you in the next video. Stay safe.